All right, thanks everyone for tuning in. On a Saturday. Hope everyone's doing okay in this what has become an increasingly volatile market here with the past um, couple of weeks, let's say. It's always a good time to sort of go back and reflect on what's working and not working. So in that vein, let's have a look at swing trading momentum stocks, something that a lot of people can probably appreciate as a strategy that is fairly wide. But the unfortunate situation for a lot of folks is that it takes a certain approach for it to actually work. So I'm hoping to be able to show you what I'm doing, what I've been doing for many years now, very successfully. I'm going to quickly leave up the risk disclaimer for just a few seconds here. All right, that's me, Serge Berger. As Reed said, I've sort of worked through the investment world from the sell side, investment banking side, JP Morgan, through the prop desks and the hedge funds and family offices, and now have my own company where I do managed accounts and trading advisory. So that's just a quick thing on me. I think it's always good to get a little bit of perspective to sort of see where we are. It's not just for trading, but in life in general. It's always good to kind of, be true with yourself and honest with yourself about sort of where you are, so you don't over or underestimate yourself. So I've sort of set these three stages that I've seen a lot of traders. And if you're just going to quickly go through this with me and kind of identify where you are, I think again it just helps for perspective. So if you've just kind of been reading and studying and have never really pulled the trigger, then you probably in the beginning stage, stage number one, and if you are in that stage, again, there's no shame in the beginning. In fact, I think you're probably in the best spot then to actually start making money in the markets, because you have no real preconceptions, or you haven't really been taught something that may not be working, which isn't the case in some folks that have been doing it for many years, but never really managed to find something worth changing. There's various reasons, mostly stubbornness being the issue. If you have an account, but you've sort of already gone through the first sort of initial fears of it, you've got greed and fear and all these issues that come up with trading. Naturally, then you're in stage number two, and you've been doing this for quite some time, for a few years, but you've spent some money on it, but you're still losing money or not making as much money as you'd like. Then you're sort of in this third stage, which is also a good stage to be in the sense that you're probably, if you've been sticking out this long, you're probably very close to making it happen, or at least much closer than if you didn't have various types of market environments according to your system that hasn't been working so far. Anyway, so that's just a little bit of a little relative way of looking at where we are. So let's get right into the meat. Quick agenda: we can talk about candlestick patterns 101. This is just for a little bit of perspective as well, and then we'll get right into the meat. We can talk about swing trading versus day trading, what I found works better of the two, and then we're going to talk about 3 steps to the trade, very much looking at and understanding that trading isn't just looking at a bunch of numbers. Best traders in the world that I know, and the hedge funds and everyone I talk to on a daily basis, there is more than just pure price action to look at. And last but not least, we can talk about my favorite option strategy, just because I think a lot of options or stock people investing or trading with either stocks or forex, ultimately what happens is that they ultimately will do some options, and so option strategy is very much a part of trading in general. So, all right. Let's talk about high beta stocks. What are high beta stocks? What are their characteristics? I think sometimes there's a bit of misconception there, and to be fair, also it's a little bit something that is a little bit depending on one's definition as well. So, in general, as far as my definition goes, high beta stock tends to be a stock that's a little bit more volatile than the broader market. They tend to be more highly sensitive to headlines, which actually is an added benefit in this case. You do have the risk of sudden up or down gaps, as you have with any asset class, the great thing about these stocks, and you'll see the other characteristics of these, is that we actually know when these up or down gaps are about to happen, or we have a very good idea of when they will. In other words, there's a rhythm to the news flow. There's a certain size of these companies and certain regulatory things. So a lot of these things, are important for the stock to be able to trade fairly cleanly, to make them high probability trades, the stocks to trade. They're also great for leverage versus the broader market. So let's say if you're trading if you're looking at a company like Apple or Google or whatever, that kind of a name, we'll go through others in just a moment. For the most part, those stocks will trade along with the direction of the market, right? That's not so much the case with certain smaller type of companies, and so that's very good. In other words, so you could in the way I'm doing is you could pretty much buy, say, like a Google, not at any given point, but a lot of times as a instead of just buying the broader market, so as a proxy, so to speak. They're also wonderful trend following stocks when they're trending, so that too is important to understand. Not all stocks trend or act the same way. Each stock, just like each different person, has different characteristics to him or herself. Stocks, it's the same thing with stocks. They often also behave very well technically, which to me is very important because that'll be technical analysis to be used from my point of view, for entry and exit levels, and not so much for the entire complete analysis itself. Let's move on. Other characteristics here, trading high beta stocks. The great thing, like I alluded to this before, is that these stocks really tend to have a very clear rhythm to the news. So you know when these corporate events are, and you just need to be aware of. So when if you trade Apple, if you don't know when Apple has a new product release like they did last week, or the fact that they have earnings coming up next week, you probably shouldn't be trading that name. You probably shouldn't be trading at all, at least not stocks. But it's very important to understand when those events are, and it's also pretty important to know when those of competitor stocks. So, for example, let's say you're focusing on a restaurant stock. So if you are, say, trading Yum Brands, or you have a position in it, you probably need to also know the earnings cycle of, say, McDonald's, or major news affecting that kind of stock. Because if something bad or something good comes out of say McDonald's that's affecting McDonald's, and it'll probably have some sort of positive or negative effect on Yum Brands in that case as well. So know the corporate events. Again, the beautiful thing is it's all there. We know that when these things are about to be released. And understand the technical levels and the personality of stock. Like I said, each stock has its own sort of personality, so you can't assume that just because stock XYZ reacts well to, say, the 21-day moving average or 200-day moving average, that any other stock will do that as well. Every stock has a little bit of a different personality, and those personalities change, or the moods, I should say, start changing as well, and that too is fairly normal for stocks. So in other words, you have to use the appropriate time frame for every given stock. So for example, a stock like Apple, from where I sit, tends to act very well through a multi-week time frame, whereas a stock like Twitter acts quite well from a 2 to 3, maybe 5-day time frame for trades. Just that's sort of the characteristics that seem to work best for those two different stocks. And then it's quite important, I think, in general for trading. I've been doing this for 15 years professionally. You got to use confirmation for trades. Just because you get a hunch something happening isn't really time to pull the trigger. What you really need is confirmation, and we'll talk about it in just a second. I'm going to go through the charts here. Okay, let's talk about Candlesticks 101 quickly. In Candlesticks, it's a very straightforward way of looking at price action. In fact, it's a much better way of looking at price action. If you are just using line charts or bar charts, I think for the most part it's kind of like driving blind, and that's not a good idea either. So you want to make sure you use candlesticks, because they'll tell you a lot more about what's actually going on in terms of price action also, but also through the lens of psychology, which I'll repeat to you about 100 times here for the next 30 minutes or so as well. So there are a lot of different candlestick patterns, and a lot of folks that I come across, whether they're professional, like institutional investors that haven't done much sort of technical work and they're most fundamentally driven, or they're brand new traders that have never done anything in trading front at all. Ultimately, when they hear of candlesticks, they tend to get a little bit scared as to what it could be. So one second, guys. Just have to adjust my microphone here. So really, the candlesticks are very straightforward, and instead of using all thousands of them that are out there, the best thing is just to focus on the ones that actually work, and those tend to be the ones that show up the most often. And we're actually quite lucky here with, in terms of the timing of this webinar, there's some very, very important, powerful candlesticks that have developed over the past few days in the broader U.S. and European equity markets for that matter. So just focus on the ones that work. If we look at the candlesticks real quick, and if for some of you this is basic, just bear with me. I'm going to talk about much more detail other stuff here in just a second. But you basically have two types of candlesticks. If you look at the bottom right hand part of the slide here, you can see you can basically have a down day, right? So the down days, you open up here, you close a little lower, but on an intraday basis, you had a move that extended above the open and below the close. So the range actually extended. So you have 4 reference points. You have a high, an open, a close, and a low. And the relationship of each one of those points to each other will tell us a lot about not only price action, but really through a lens of psychology, you can sort of take a lot from that type of relationship. And then if we look at the other type of candlestick, which is an up day, you can have an open, a higher close, and again an intraday move that extends beyond the open to close relationship. The most important part of this high, low, open, close relationship on the candlestick, for me, as a swing trader of having time frames anywhere between 2 days and 4 to 5 weeks, to me the most important is the daily close. I need to see that on a daily close the candlestick has done something of importance or significance to me. And I'll show you this in many charts here just in just a minute. So the other great thing, and I think this really goes very much with my process of keeping it simple, I have worked with many traders on the institutional side, many very quantitatively oriented folks as well, and I can tell you for the most part, the guys that I've kept it the simplest in the sense of having a straightforward analysis that doesn't confuse themselves and doesn't give too many confusing signals, those tend to be the ones that can actually repeat their process. They have a repeatable process, and having a repeatable process that doesn't confuse the heck out of you every single day is really, at the end of the day, is the key to success in this business. So the great thing about candlesticks is that 60% of us, of us traders and most actually just people in general, have an easier time understanding something with a series of pictures as opposed to just a series of words or numbers. So that's the visual learning. It's the right part of the brain, the creative part of the brain, and of course the candlesticks are a very visual thing. So you're basically learning something about not only just price action, but again investor psychology and investor sentiment in the market. But if you look at candlesticks. So I'm going to quickly go through a couple things here on the benefits of candlesticks. If you don't see every single thing on the chart here, it's not so important. What's more important for the next few slides is the big picture. But again, the candlesticks are more visual than the bar or line charts, and they just give you a lot more information. And essentially, what they're telling you is that they're giving you a very clear representation of price action and really investor sentiment, and by the same token, footprints. You can really detect the footprints of what investors, particularly big investors, have done on any given day, particularly when that footprint is extremely clear. So again, you're getting a visual representation of what's happening in the market, looking at it, not just understanding, thinking that it's price action. I find that a lot of people have found it easier to look at it and try to sort of think of it more as what's investor sentiment at any given point. And basically the benefit of it all is that if you see investor sentiment being extremely bullish, ultimately you can take the opposite of that and make money, because once everyone's doing the same thing, ultimately there's no more buyers and the market has only one way to go. So let's talk about the other thing about candlesticks. At the end of the day, it's just, the thing is they just work. So the formations are very simple, straightforward to spot once you've been trained a little bit, and it really translates into decision making without emotions. So if you look, for example, this person here on this cliff, the reason I chose this picture is because this person, him and her or her, at some point here has extremely defined risk. If if she or he walks past this point, you know, that would be an issue, right? So it's very important to have a tool or a part of your process that tells you exactly what your risk is when you get into a trade. And the more visual that I've found this over the years, the more visual that level is or that area is, the better you'll be able to actually stick to your rules. A lot of people just have you know, sort of random levels, or they're not very clearly defined, both as targets and stops. But the more clearly defined those levels are visually, particularly visually, then the easier time you'll have sticking to your rules. And at the end of the day, really what it comes down to is you lose less money, you'll make more money over time, and you become very much more of a steady type of trader as opposed to someone who just has these massive curves in your P&L curve. So let's look at some types of candles that we can look at. I'm going to start very basic just to kind of give you an idea. And again, try to think of this more through the lens of psychology, through the lens of investor sentiment as opposed to just purely price action. Again, I just found that to be easier for folks to digest. So here we have a Doji Candle. This is very much like what I showed you before, but if you think about this and just look at this one all the way on the left here, this is a simple Doji Candle. So you have an open, which is basically an open and close of this, let's say this is daily candle that took place at the same level. So let's say this is a stock that has a $50 price tag on it, so it opened on day XYZ at $50. On an intraday basis, it traveled up to 52, but it also traveled all the way down to say 45 intraday. After all that, it actually ended up back at 50 bucks at the end of the day. So what does that tell you? Again, you can look at it from a price action point of view, which will tell you, okay, there's not much going on. But you can look at it another way and say, listen, well, it looks like bulls and bears are somewhere, there's some sort of equilibrium. And let's say you have 4 or 5 of these kind of days in a row, right? That tells you, well, yeah, there's some sort of consensus, but the longer that holds on, longer that continues, the ultimately more volatile or vicious the move will be in one direction or another. So again, think about it that way through the lens of psychology as opposed to just price action. Next, we have the hammer candle, which is also visually extremely clear when they show up in the chart, and I'll show you the hammer candle. A beauty of a hammer candle that I just developed on the S&P 500 actually earlier this week. And basically what you have here is you have a situation where the stock or index or whatever you're looking at, you could be looking at a currency or a commodity in any sort of futures contract. And basically you have a day, it doesn't matter whether it's an up day or a down day. I'm just going to go with this one up here. And let's say this is a stock that opened at $50. It intraday then traveled all the way down to $40, but then ultimately rallied back very strongly, ended up closing the day at $52. So what this tells you is, yes, okay, it tells you that the stock couldn't keep down. But if you think about it in a different way, it basically what tells you that the bears lost control of the game, right? So ultimately, bears ran out of firepower, and the bulls quickly took over the game, right? So that then gives you a very clear reference point. In other words, if the very following day the stock drops below this level again, then you know that was just a fake out move. On the other hand, you can then use that level to trade against on the long side, and I'll, without further ado, let me just get right into the chart of the S&P 500 so you can see what I'm talking about here. Just look at this. This is the daily price action of the S&P 500, and look at this here. We have a beauty of a hammer candle that took place on Wednesday when the market dropped all the way down to 1820 on an intraday basis. The bears lost control of the ball, reversed back up, and basically give us a clear level that they're, at least for a little time right now, they were exhausted, right? So then what you need at some point of the ensuing few days is some sort of follow-through buying, which we did have here on Friday, where we actually saw a higher close than what we had on Thursday, and that is typically a pretty good setup to go long a market for at least a couple of percentage points. And for an index, that's different than it is for an individual stock. But I think more importantly than looking at this as a risk, as a reward chasing. It's all about risk management. Right? That's what this business is all about. So right now we have very clear defined levels. So if this market drops below 1820, and it certainly can, but if and when it does that, it'll definitely go lower, right? So that's your reference point, and that's the beauty of a hammer candle. Again, think of it of that being the level 1820 in the S&P for in this example, where the bears basically sort of ran out of steam. They gave it all they had. They really tried their best on Wednesday to scare the heck out of folks, and they did, but ultimately they ran out of firepower, and the bulls took over the game. So very, very visually obvious thing that's taking place here on the chart with having a hammer candle. So let's talk about sort of the advantages and disadvantages, but really just kind of looking at day trading versus swing trading. The things that I've found over the past 15 years. You have the intraday trading, which is really something that takes a lot of focus. I personally think it's not something for beginners, for lack of a better term. It takes a certain personality. You really have to be in and out of the trades, usually fairly quickly. These days you have high-frequency trading where, particularly if you're trading in single-name stocks, for example, you have a situation where any news flow or even just sort of a little blip in an algorithm can quickly stop you out of the market and essentially ruin an otherwise very good and valid setup for you, and what it ends up doing is it kind of starts chipping away at your confidence. So intraday trading, it really does take a personality. I think it takes quite a bit of experience to be good at that. And on the other hand, you have swing trading, which is really it's not nearly as stressful as day trading, but it's also not boring. You have the time frames of 2 days to 4 weeks by my personal definition, and I found that for most people that I've ever spoken with in trading, that seems to be a good comfort zone for most people. Whether you have a part-time job, a full-time job, you are retired, or semi-retired, or you're a student even, or a stay-at-home mom, anything and anyone, it seems to be able to work with this time frame. Both psychologically it seems to work for them, but also literally it seems to be able to fit into their days somehow. So it's a sweet spot. You have clear and defined stops and profit targets, and really you can use these candlestick patterns to find terrific trading setups, as I'll show you here in just a minute. Let me see what this next slide was. So the other great thing about swing trading is that you really have a sweet spot, not only in terms of the time frame that it seems to work for most people, but also because you get sort of very uncrowded trades, right? You have day trading where you have a very crowded space with everyone, from algorithms to just the day trade in general, fighting for every tick. In swing trading, that's by definition it's more than intraday, so it's at least 2 days, which tends to be too long for day traders, of course, because by definition they can only trade within a day, but it's also too short for institutional investors who like to have positions on for usually a few months. So you tend to get this space of uncrowded trades, and that's a good thing when it comes to trading. So look at a few examples. I'm just going to give you a sort of a bigger picture idea. I cut most of these charts a while back. Twitter is fairly recent, like a few weeks ago, but you'll see some of these other charts a little while back. I'll then show you some real-time stuff so you don't think I was cherry-picking the stuff I'm talking about. You come across in the charts every day. So what's important to understand here, for example, on Twitter is that you had a very solid double bottom here earlier this year in May and I guess it was in May and early June, something like that. This was then followed by a consolidation and breakout area, a breakaway gap, then really was the most bullish thing that's happened on the Twitter chart for, as far as I'm concerned, the past 6 to 8 months, and that was on July 30th after the earnings. So you see a very orderly flow, a great high beta swing trading stock that gives you clear reference support and resistance areas where you have the news flow. You know when the news flow, there is volume, there's enough of a following in the stock, and just generally good stock to trade also from a technical perspective. Another example here, for example, is First Solar. Again, this is a chart. This is like almost a year old, this chart, but it's that the more important thing is that you see how the chart worked at the time, and you can see the stock reacted very well to its supporting 21-day moving average. That's this yellow line. You had a very clear hammer type of candle here happening before earnings in early November 2013, which in retrospect, after the stock then shot higher on a bullish breakaway candle, could have been used as a confirmation candle that actually this breakout is valid. It's sort of a reverse way of thinking. A lot of people look at just the days or the weeks action. If I see a move happening, I want it to be confirmed by the action previously. So in this case, the stock gapped higher in early November 2013 after earnings, and then looking back at the price action that preceded it, I see a lot of bullish reversal candles where the stock managed to hold support, and that in retrospect actually supported the breakout, and then it usually tends to give us a pretty good entry spot to go long, in this case, the stock for a quick 5 to 10% move. The point isn't to be greedy in this business. The point is to be disciplined and have a system that's repeatable. And what I've been doing developed over the past 15 years, from all the sell-side investment banking shops to, or banks, I should say, to all the buy-side I've worked on, I have found that this is certainly something that's repeatable for most people as well, because again, it seems to fit both the visual approach that people prefer, but also the time frame that people can spend on it. Another chart, Hewlett Packard. Again, this chart is about a year old. What we had at the time last autumn was a downward sloping channel. You can see what this was a price action taking place in a very uncharacteristically tight spot. You then had bullish breakout candle on, I think it was the 9th of October, if I remember correctly, after the company had an investor meeting day, and the stock just broke out very strongly right back above its 200-day moving average. So then what you go back, and once you see this kind of a move, and this kind of news you'll hear everywhere, because this is something that's being picked up by all the financial news websites and TV and everything like that. So you be aware of this move, but then don't just blindly buy it. Go back and see if you saw any sort of hints of the stock actually being able to do this, and then here too you saw that the stock actually had a lot of support, supporting candles, bullish candles. That it was telling us that the investor psychology was starting to get a little bit too bearish. So the stock is definitely well supported down there, and the stock should be able to work higher. And of course, Hewlett Packard then screamed higher for the ensuing like 10 months or something like that. Another one, Microsoft. This stock too obviously has done look a lot different now than it was a year ago. But again, we'll show you up-to-date charts here in just a minute. You have a very beautiful series of higher lows and higher highs that developed here in this stock over time. You then had quick bullish reversals taking place on all these higher lows, which is very nice because it tells you that buyers are there to support the stock. Gaps past resistance points also is a bullish thing to see, because it tells you that buyers aren't just buying; they're literally giddy after a stock has a certain support level. And all of this is being supported by very bullish candles. So if you were to squint and look at this closer, you would see a lot of these bullish hammer candles that I showed you before showed up every time the stock made a higher low, and every time was a beautiful spot to buy the stock. So that's a technically very sound stock, not so much a high beta stock, but in this particular example, but a stock that reacts very well, not only to technical analysis, but also to the news flow that it provides us with. And that brings me to 3 steps to the trade. I said before that I think it's difficult to be a pure market. Personally, I think that's a difficult thing to be a purely technical trader. So I think it's important to have a couple of steps in this. In other words, first, I think it's important to understand the broad structure of the market. You need to understand basically what the monetary policy and the political environment is of the market. So the monetary policy, I think, is extremely important to understand, particularly because the money supply and just in general the feeling of how dovish or hawkish any given central bank is will be able to sort of dictate how the market will react. Of course, we've had a very easy money policy over the past 5-6 years now. In the U.S., the Fed is getting a little bit tighter, at least, or or at least less easy, let's put it this way, and that could manifest itself into some more higher market volatility, as of course we've witnessed over the past couple of weeks in equities. We've seen it in other asset classes well before. Step two, once you see what's going on in monetary policy, and you don't have to become an economist for that. In fact, it's probably better if you're not, given certain track records, but that's sort of a different topic. What's more important is, you kind of keep a tap on what's happening. Just be aware of the general trend of the monetary policy of whatever market you're trading. If it's the U.S., you got to look at the Fed. If it's Europe, you got to be aware of the ECB, so on and so forth. And Japan, of course, you have the Bank of Japan, things like that. So just be aware of that. And so once you see that, and once you see the trend, you want to look for stocks that are reacting well in the direction of what the current market is being pushed to, given the broader structure of the market. And once you have that, you can then use something like Candlesticks, which is my preferred way of getting the entry signals, among a few others straightforward indicators, to really give you the entry, target, and risk management points. So that's it, step 1, 2, 3. And if you were to apply that in real life, you see something like Hewlett Packard here. Showed you the close-up chart before. This is a bigger picture, so looking back a year or so, you had a stock that had a very sharp bounce off of the late 2012 lows, ultimately ended up retracing about half of that move, and then after holding the 50% retracement mark, again, was very obvious that the stock was ready to move higher again in the bigger picture, not so much in the near term, but in the bigger picture, which then made an interesting candidate to look for candlesticks and that kind of stuff to focus on and actually get the buy and sell type of signals. You can look at First Solar. Again, this chart is a year old, so you don't have to necessarily look at it compared to today. But you see this market structure was solid back then. You had a stock that had a very nice bottoming pattern, breaking past its multi-year downward trend, and so started making a series of higher low and higher highs. Again, in accordance with what the monetary policy was, easy money, i.e., there to inflate asset classes, and that type of idea. Then it was worth it looking closer at candlesticks to really get your reference risk-reward levels. Last but not least, Twitter. Again, this is obviously a more recent chart because Twitter hasn't been around for that long. You can look at Twitter and you can see a very solid double bottom, as I said earlier, started breaking past this downward trend from the late 2013, or I guess it was early 2014 top. I forget when exactly topped. And then started making a very nice series of higher lows and higher highs. Again, very solid stock, but then look for candlestick setups within that framework, understanding that the news flow, of course, needs to be monitored closely on any of these kind of stocks. So that's the 1, 2, 3 step approach. I have a whole bunch more to cover here. We'll get to your questions in just a minute. But I did want to talk about the best option strategy that I've ever come across. A lot of people like to trade stocks from a directional point of view using options. And while I think that's not a bad idea, I do that myself for the funds and the managed accounts and for the trade alert service and things like that. I do think that a higher probability trade for the folks that don't want to sit in front of the computer all day really is just to be a net seller of options. In other words, selling credit spreads or put spreads for premium when certain criteria are met. Very simply, the most highest probability trade in options that I've ever come across asset classes. We do this a lot in the bond market, particularly with derivatives, with current default swaps and things like that. Basically, when you have a chart that goes from steep to vertical, okay, steep to vertical, you have an increasingly high chance that at some point that stock will mean revert to the downside quicker than any other stock out there on a relative basis, simply because it's like when you stretch the rubber band, it'll snap. You go overstretch something, or you push down on a spring. It's the same kind of concept here you can think of. What you then do is you sell out of the money puts, or in this case calls. If you're going short, you sell out of the money calls or call spreads. Sometimes you can do this like 20, 30, 40% out of the money. So let me give you an example. Let's look at a chart here. For example, I'm trying to think of a stock that went vertical, like Tesla, for example, right? So let's look at Tesla, and obviously a stock that's been widely followed. And you can see that this stock basically went from very steep in late last year to basically an absolute vertical leap here in just this past February. You then would have been aware of that vertical leap, and all of a sudden all these bearish candles started appearing. Momentum was waning. A lot of the longer term momentum indicators were giving us negative divergence. In other words, momentum was not confirming the vertical move. All these bearish things are happening. At this point here, you could have sold far out of the money call spreads for very, very, very juicy premiums. In other words, your bet at this point is that the stock goes down. But let's say you could have sold, let's say you could have sold options, calls, or call spreads out of the money for like 25% out of the money for a good premium. This stock could have actually risen to $300 plus, and you still would be making money at the end of expiration. So if you think about that, guys, you're making a bet that the stock's going down. But if this stock does not go down at all, but rather say crazy is that? So from a pure risk-reward probability perspective, that's a very juicy trade. But again, it's important not to do this on any chart. You want to do this on stocks that take a chart that's steep to vertical, and then making sure you start looking for signs of exhaustion, and then you do this kind of trade. You don't just blindly do it on any stock that's rallied for a few percent for a few days. That's not good enough. So this is the type of trade that I do on a monthly basis, and we roll them, and so we have a continuous portfolio. It's almost like a real estate income stream that really kind of gives us very steady returns just on this type of a setup. So very straightforward, and not something that I think takes a lot of attention to either. All right, Netflix would have been another example. So I'm going to quickly summarize this, and then we'll get some Q&A. Candles show investors' footprints and emotions, which is an extremely valuable thing to do. So watch for candles that confirm the price action. Don't just blindly do this kind of stuff, this kind of trading without confirmation. That's extremely important. And then please be aware that you need a multi-step process, or at least more than a single factor model. You need to have a bigger picture idea of the broader structure of the market. You can then scan for technically sound stocks or commodities or whatever you want to trade in the direction of that general structure, and then you can use something like Candlesticks to very visually give you entry, risk, reward points that then make it much easier for you to actually be able to stick to your process. All right, it was Albert Einstein that said the definition of insanity is repeating the same behavior and expecting a different outcome. And I think when it comes to trading, it's extremely important to keep in mind that as much as we all need a plan, those plans do need to be somewhat flexible. And the beautiful thing about Candlesticks and the type of approach that I've shown you is that it allows you, the visual nature of it and the time frames of it allows most folks that have an easy time learning things through a series of pictures as opposed to looking at a spreadsheet. It allows them to be able to understand when they need to be more flexible, or when they need to make changes to their approach of, let's say, when a bull market turns into a bear market from a cyclical perspective, for example, like we just saw happening over the past few weeks in equities. So a plan is there to increase your accuracy in trading and really to keep you sane and to keep you from having big drawdowns in your P&L, because there's nothing worse in trading than having big P&L drawdowns, because it not only is it annoying to see a lot of money go away that you've worked hard on, it's also really messes with your head to see that kind of drawdown, and it basically makes you doubt your own system. So we'll have a quick Oktoberfest special that we're going to do, and then we'll go to Q&A in 1 second. I recently launched a Hot Stocks to Watch daily trade alert, or daily trade idea. It's an annual subscription in this case, and every single day I send out my best trade idea for that day. They're not day trades, mind you, like I said, but they're the best idea for that day. For example, I'll give you an example of what I wrote out on Friday, so yesterday. You get the very straightforward analysis of the trade, very much like the type of chart I just showed you. It talks. I had a chart and an analysis with clear entry and risk management points, and of course the reason behind it. You also get a lifetime access to my video training course, which is a recording of something like 20 plus videos that go through all sorts of strategies that I use to manage money in real time and real life. And of course you also get to message me and ask me any questions that you have on the market for as long as you are there. So all of this usually would be $196. Today we're going to offer it for $47, so that's 76% off for all of this for 5 trades, trade ideas every single week when the market's open, of course, and sent to your inbox every morning at around 8 a.m. Eastern. You can go to vip.marketfy.com/hot, H-O-T, to take advantage of this. vip.marketfy.com/hot, H-O-T. So that's the offer there. All right, let's go through some questions, guys. Getting a question, what about sectors and strong, weak stocks in them? So I think if I read the question correctly, and please keep the questions coming, what's being asked is that, is it important to sort of have an idea of like, what's relatively strong, relatively weak? Yes, absolutely. And I think here too, you want to be aware not just of what's relatively strong, like for example, the banks are extremely important to watch for that kind of stuff all the time because it gives you a broader clue about the market, but also understand what it tells you when a certain sector is lagging. So for example, if like the small cap stocks are lagging versus the larger market, like it has for most of this year until it finally caved a couple of weeks ago, that's not very good, right? So that's telling you more than just the fact that small caps should be shorted on a relative basis, but also tells you that basically at some point there should be some concern. I think the small caps tend to lead the large caps in that kind of thing. What is for the options trade, someone's asking what kind of expiration do I use? I try to use at least 2, preferably 3 to 4 months out. So if I'm going to do a trade on one of those vertical leaps and I sell for all call spreads, I like to sell them at least 3 months out in the future, because that gives me enough time premium and enough time to let the trade breathe. Next question is, what's your swing trade now for Apple and S&P? Well, I tell you what, if you subscribe to this, I can tell you this in more detail, but I'll quickly go through it. In fact, actually, let me do this. Let me tell you, for example, the trade I sent out, the trade idea I sent out on Friday morning was to buy the XLE, the energy. In fact, I talked about this previously in the week, and then on Friday I actually suggested the setup. The XLE, the energy sector, of course, has been getting beaten up very strongly, and we had a massive bullish reversal on Wednesday, followed by a big outside bullish day the following day on Thursday, and then on Friday morning we gapped high with beautiful. This ended up being actually day trade, not because I wanted it to be a day trade, but because we had the target set. So I think subscribers were very, very happy with that, and a lot of folks send us thank you notes for that. The S&P near term, what do I think? I think I don't think we're out of the woods just yet. Apple has earnings on Monday. I will not touch Apple until it's out after earnings. So you can then start looking for the risk range once it actually has reported earnings. What candlestick patterns have the highest probability to look at? Say what's the top 3? Bullish reversals would be candlestick hammer candles, outside days of any sort, bullish or bearish outside days, and then anything that has an up or down gap. So let's say, for example, in the XLE, just because we're at the chart, this is the energy sector ETF. You would have seen that this ETF actually gapped higher the next day. So this would have been on a daily closing basis a very, very bullish type of candle. The problem is it wasn't, because it had an intraday sell-off. So, but really, I would focus on hammer candles and outside days. If this program is called Hot Stocks, I'm not sure I understand that question, Leon. What the product is just it's five trades every single week, Monday through Friday, 8 o'clock. You get the trade idea sent to you very clearly represented with charts. You get entry levels, target risk management levels, the reason behind it. And again, you know, the type of thing like XLE will talk about any sort of high beta stock, whether this is a trade to set up like Teslas, Apples, all those kind of things. Again, it's a no stress way of trading. You don't have to sit in front of a computer all day and day trade. What we're talking about here really is a system that can be done whether you're a full-time trader or you just want to take a little bit of time every single day to look at the market. Thank you, Chase. She says, here's a very good presentation, clear, concise, and value priced. I mean, excellent. Thank you. It's good to have you on board. Let me clarify, guys. The $47 is for 1 year. So you get the entire year membership. So what you get is you get my 5 days a week, every single day. You get a trade alert for an entire year. Plus, you get access to the entire video course. That's a lifetime access to the video course, right? And of course, during that time as well, you can message me. As long as you're subscribed to the Hot Stocks newsletter, you can also message me for 1 year. So the $47 is 1 year for the trade alerts, but you get a lifetime access to my video trading course. Does it come with one of those beers? I tell you what, if you have a successful trading streak of a couple months and you can send me your P&L, I will send you a case of beer. How about that? All right, guys, I think that's it. Let's leave it at that. I'm probably running out of time. Reed, thank you very much. Thank you, guys. Again, vip.marketfi.com/hot if you want to take advantage of that. Otherwise, safe trading.